Imagine looking at the global financial system from above. Markets are moving every second. Stocks change price, bonds reprice, currencies shift, pension funds rebalance, insurance companies manage enormous portfolios. Trillions of dollars move through a system that appears chaotic from the outside. But underneath that chaos is something far more organized. A layer of data, models, software, and risk infrastructure, helping institutions understand what they own, what they are exposed to, and what could happen next. Most people never see this layer. They see the market, they see the price, they see the headline. But the institutions operating at scale need something else. They need a machine capable of turning complexity into a picture they can actually use. And one of the most important machines built for that purpose has a name most people outside finance rarely think about: Aladdin.
Managing a small portfolio is relatively simple. You know what you own, you know where the money is, you can look at the positions and make a decision. But scale changes the problem completely. An institutional portfolio can span thousands of securities, multiple countries, currencies, asset classes, managers, and investment strategies. Now imagine trying to understand the risk of that entire system at once. What happens if interest rates rise? What happens if inflation accelerates? What happens if an emerging market collapses? What happens if credit spreads widen, currencies move sharply, or several risks appear at the same time? The problem is no longer finding an investment. The problem is seeing the entire machine, and that is where financial technology becomes infrastructure.
This is where the architecture becomes interesting. Modern finance does not simply need money, it needs coordination. Data has to move between systems. Portfolios have to be monitored. Trades have to be processed. Risk has to be measured. Compliance has to be maintained. Different teams need to work from consistent information. At enormous scale, these functions cannot remain isolated. They have to connect. Aladdin was designed around that idea. BlackRock describes it as a central processing system for investment management, connecting functions across portfolio management, trading, operations, compliance, and risk oversight. In other words, the software is not simply looking at markets, it is helping organize the process through which institutions interact with them. The power of a system like this does not come from a single prediction. It comes from standardization. When different parts of an organization work from different data, different models, and different definitions of risk, complexity multiplies. But when the same architecture connects investment teams, operations, risk managers, and other functions, the organization gains something extremely valuable: a common language. BlackRock describes Aladdin as a platform built around a common data language across the investment management process. That sounds technical, but economically it is significant, because once a system becomes the common language through which complex decisions are organized, replacing it becomes more than replacing software. It means changing the architecture of the institution itself. The next layer is risk. Markets are uncertain by definition. No model can eliminate that uncertainty, but institutions can model it. They can ask what happens under different conditions, stress portfolios against possible shocks, and examine where exposure is concentrated. Aladdin's risk capabilities are built around this kind of analysis, covering multiple asset classes and allowing institutions to examine scenarios, exposures, and portfolio risks. That changes the role of software. It is no longer simply recording what happened. It is helping institutions think through what could happen. And once financial decisions become deeply connected to analytical infrastructure, the software becomes part of the decision-making architecture itself.
Then comes the network effect. A financial platform becomes more valuable when more institutions use compatible infrastructure. Data becomes easier to organize. Processes become easier to standardize. Integrations become more useful. Knowledge accumulates. The system becomes familiar. And familiarity matters because financial institutions do not change infrastructure casually. Their systems touch portfolios, operations, compliance, reporting, risk, and daily decision-making. BlackRock says Aladdin and its risk analytics are relied upon by more than 200 institutions, including asset managers, insurers, pensions, corporations, banks, and official institutions. That does not mean one system controls the market. It means something more subtle. A piece of financial infrastructure can become deeply embedded in the institutions that operate the market. The modern portfolio is no longer just a collection of stocks. Institutions manage combinations of public and private assets, fixed income, currencies, real estate, commodities, derivatives, and other alternatives. That creates a second-order problem. Risk does not exist inside one asset class. It moves between them. A currency shock can affect a bond portfolio. Interest rates can change the value of real estate. Credit stress can spread through institutions that appear unrelated. The system therefore needs to understand relationships, not just individual positions. Aladdin is designed as a multi-asset platform, supporting risk analytics across equities, fixed income, foreign exchange, derivatives, real estate, commodities, and private markets. The deeper the portfolio becomes, the more valuable a unified view can become. This is where the story moves beyond BlackRock. Because the deeper lesson is not really about one company. It is about the evolution of financial power. Software used to sit beside the business. Now, in many industries, software sits underneath it. It coordinates operations. It organizes data. It measures risk. It connects institutions. It creates standards. And once enough critical processes depend on that architecture, software stops being a tool. It becomes infrastructure. Infrastructure creates dependency. Dependency creates switching costs. Switching costs create durability. And durability can become economic leverage. The most powerful technology is not always the technology people notice. Sometimes it is the system they stop thinking about because it has become part of how the industry works. There is a powerful distinction here. You do not necessarily need to own every asset to become important to the system managing those assets. You can own the infrastructure around the decision, the data layer, the analytics, the workflow, the risk engine, the operating architecture. This is one of the oldest principles in business, translated into the digital age. Own the bottleneck, and you can participate in the value created above it. The difference is that modern bottlenecks do not always look physical. They can be software, they can be standards, they can be data models, they can be systems that connect thousands of decisions together. And because they are invisible to the public, their strategic importance is often underestimated. Now the architecture begins to compound. Capital creates activity. Activity creates data. Data feeds analytical systems. Analytical systems support decisions. Decisions create more activity. And the infrastructure becomes more valuable as the ecosystem expands. This is how financial technology can become difficult to separate from the financial system around it. Not because the software owns the market, but because it helps institutions operate at a scale that would be difficult to manage manually. The value comes from coordination, from consistency, from speed, from the ability to see thousands of moving parts as one system. And once the system becomes embedded, its economic value is no longer limited to the software itself. It becomes connected to the scale of the market that depends on it.
And this is where the idea of financial power becomes more interesting. Power does not always sit with the person pressing the button. Sometimes it sits with the system around the button, the infrastructure that determines what information is available, the models that organize risk, the software that connects the workflow, the architecture that allows institutions to operate at scale. That does not mean the system makes every investment decision. It does not mean a single company controls global markets. The reality is more nuanced. But nuance is exactly what makes infrastructure powerful. It does not need absolute control. It needs strategic importance. Because once a system becomes deeply embedded in the machinery of finance, its position can matter far beyond the screen where the software appears. And the next phase may be even more important. Financial infrastructure is becoming increasingly automated, connected, and data-driven. Platforms are expanding across public and private markets. Risk analysis is becoming more continuous. APIs connect systems that once operated separately. AI is beginning to sit on top of these enormous datasets, helping institutions analyze information and navigate increasingly complex portfolios. BlackRock itself describes Aladdin as an API-first platform and continues expanding its capabilities across the investment process. The direction is clear. Finance is becoming more software-defined. And when an industry becomes software-defined, the architecture underneath the industry becomes strategically important.
So, what is the machine behind the market? It is not one algorithm. It is not one trader. And it is not a secret button controlling the global economy. It is something more structural, a growing layer of software, data, analytics, and infrastructure that helps institutions manage an increasingly complex financial world. Aladdin is one important example of that transformation. BlackRock built it as technology for investment and risk management, and it has become a platform used across a broad range of institutional clients. The larger lesson is about architecture. Markets create enormous amounts of information. Institutions need systems to organize that information. The systems become infrastructure. Infrastructure creates dependency. Dependency creates leverage, and leverage creates economic value. That is how power moves beneath the surface. Not always through ownership, not always through control, sometimes through position. The position between complexity and decision-making, between capital and information, between the market and the institutions trying to understand it. Because in the modern economy, the most valuable financial asset may not always be the money itself. Sometimes it is the system that helps everyone else know what their money is doing.
Next era. Decoding systems. Architecting wealth.